when there's a lot of negative news out there, it often leads to an opportunity to buy the share market at a discount. Hey, this is Chris. What should I do with my money now is one of the more common questions we get from clients. So I'm going to be talking in this video about each of those different buckets and what my advice would be to clients at the moment. Now, we're currently in an environment where we're seeing a lot of inflation, and that inflation is rising and expected to rise further in Australia to over 7% by the end of the year. As a result, interest rates are going up and going up pretty quickly. And we've also seen a share market that's fallen about 10% over the last year. So that's the environment we're in at the moment. Now, what does that mean for people with money in the bank? Well, my recommendation at the moment would be to shop around for a better interest rate, because what we're starting to see is that even though banks are very fast to pass on mortgage rate increases when the interest rates are rising, they seem to be very slow at passing on interest rate increases for deposit accounts and for term deposits and for savers. And so it is worth looking around for a better rate. An alternative that might be right for some people as well is a cash ETF. And a cash ETF actually shops around for the best interest rates and does deposit the money with major banks in Australia. That is an alternative that may also be able to give you a better interest rate and at least give you a bit of a benchmark to be thinking about when you're looking around for your cash savings. So it's a really good time to shop around, because banks will definitely lag in actually giving their customers better rates, and you could be missing out on 1 or 2% over the next year if you don't shop around. The next category is people with mortgages. Now, on the basis that interest rates are about to rise quite quickly, my strong recommendation would be for anyone with a mortgage to carefully consider reducing that mortgage if they can, if you're able to chip away that mortgage over the next little while, because any mortgage that you have left over in a year or two when interest rates are much higher is going to lead to a much higher interest charge each year, and the cost of servicing that loan is going to get harder and harder. So if you do have an opportunity to pay off some loan, good chance to do that at the moment before interest rates are higher. There's also a psychological benefit, I think, of having a bit of a buffer in your mortgage, in case other changes happen in the economy that make it tougher, in case you lose your job or if interest rates rise faster than expected. So building up a buffer, I think, is a sensible thing to be doing at the moment, given that there's a lot of unknowns and there's a lot of debate at the moment about where interest rates will be in a year or two. No one really knows, even the central bank, and so I think it pays to be a little bit conservative with your own personal finances right now. Now, the other type of loan, apart from home loans, is other personal loans, and it might be a bank personal loan or a HEX loan or something like that. With those as well, I would be trying to pay off more if possible, because what you'll see is that personal loan interest rates will also go up pretty fast as interest rates rise in Australia, and the HEX loan that people have, because it's indexed to inflation, you'll see the size of that loan increasing as well. So even over the last year, the indexation of HEX, or how much it goes up by each year, has increased from 0.6% last year to 3.9% this year. So that means debts are increasing very fast. If you can knock over that debt, it's going to really help. And the final category I wanted to talk about was investments. Now, our advice to clients is, look, even if interest rates are going up or there's a recession or really whatever the news is, provided you've got an appropriate time horizon and a capacity for markets to go up or down in the short term, you should be continuing to invest. It really doesn't matter what the scenario is. It's very hard to predict where the economy or where the market's going to be in 6 months or a year, but what we know is that over the long run, investing is a great thing to do. So don't be tempted to react to every negative news headline. Bad news that everyone already knows about is already embodied in the price, so probably isn't going to lead to share prices falling further. And actually, when there's a lot of negative news out there, it often leads to an opportunity to buy the share market at a discount. And so with markets being down 10% plus over the last year, that's a dip that, may be a great opportunity to invest in over the long run. But again, I would strongly stress diversifying, because in a volatile period for the economy, what you'll probably see is a lot more companies going bankrupt. So you don't want to have all of your chips on 1 or 2 companies. You want to spread it across the whole index, invest across different asset classes, different sectors of the economy in different countries, because it may be a sector or a country that does better than Australia or better than what you expect. So it's really important to make sure your money is spread out very widely when markets are volatile and when the economy is in a period of of unknowns. And they'd be my tips for investors at the moment in a period of high uncertainty, rising interest rates, and higher inflation.